Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, today we've had the GDP data just released for the fourth quarter. Interesting numbers in there. What's your take?
They are interesting. I think that's probably a good way of putting it. There's a mixed bag. Some people will take it as positive, some will take it as negative. So quarter on quarter grew at 0.4 of 1%. Expectations had been for 0.5, so a slight miss on that, and down from 0.7 in the quarter before. Year on year, 2.4% versus 2.5% expectation, and again slightly softer than the previous quarter year on year, which was 2.6.
Let's break down the numbers.
Because I think that's a good way to look at it.
Yeah, so I saw Treasurer Morrison talking about jobs. He's really upbeat on that. We've seen growth in consumption.
Yep.
Let's go over that in more detail.
Yeah, that's his argument. So if you have a look at consumption, it was a power figure at 1% growth year on year. And that is the best figure that they've seen in consumption since 2012. It does highlight that last year's employment figures, not the wage growth, but employment figures are probably increasing confidence. We did see that in Westpac's consumer confidence numbers, that they were particularly at the back end of last year picking right up. So you can make that argument. He also pointed out the fact that if you look at the September consumption figures, they were upgraded from 0.1 to 0.5 of 1%. So that is a good add to it. I think you need to highlight government contribution. So when we talk about GDP is consumption plus private investment, government investment, and net exports. We'll get to net exports in a minute, but government investment or government spending is what it really is, still well and truly out contributes where it probably needs to be. And what I mean by that is that if we didn't have state and federal government doing infrastructure projects, et cetera, GDP would probably look pretty horrible. That's a given, because private investment still isn't picking up the slack, and it was one of the bigger contractors in this figure that if you have a look at. Now, that was probably a known, and what I mean by that is that we knew from about 2 weeks ago, we saw the building construction data come out, and there was a ginormous plummet in engineering. Now, that is down to the fact that the big LNG projects, particularly over in the Northwest Shelf in Western Australia, have finished. So they fell off a cliff. And that's part of the reason for it. But we also knew from the CapEx data that came out last week that it was just softer than expected. And therefore, you were probably expecting a disappointment in private investment, and that's come to fruition. Net exports is the other part of it. It did take out about half of 1% out. That was known. We saw that in the current account deficit yesterday. We also saw that coming in a couple of weeks back with the trade balance numbers. Again, push-pull on that. We saw a big increase in imports. Particularly December, exports on iron ore and copper slowed right down. So we got done on the export side. We actually contracted on exports, and we saw a huge influx of imports. So net exports, net, we had a negative number, and that took out.
So the annual number was 2.4. So
it's good.
Roughly on track.
It is. It's good. If this is the way you've got to ask yourself. If you want to look at glass half full, compare ourselves to the rest of the world, we're doing quite nicely. We are growing at or just above the US in terms of where their percentage movements are. So that's a good comparison. We're well ahead of a few others. Europe's just overtaken us. Interesting. But if you look at it from the point of view of where we need to be and what the RBA expects us to be and what the federal government expects us to be, we're below trend. So we're not going to make the 3%,
which is probably good on the rates front.
Yeah, the rates front is the argument, isn't it? Because it does keep the RBA out. We heard this morning Philip Lowe giving a speech at a fairly large summit, basically forewarning that the GDP figures were slightly softer. They did on Tuesday take out that expectation of about 3% GDP in 2018. They said that there is still good growth and growing at a reasonable rate, but they no longer had the estimate of 3%. So that's again just suggests it's just slight disappointments. We just cannot get ourselves to a level that is showing really good signs. But from a rates perspective, 2018 is less and less, and I can't say it enough, likely to see rate rises. It is the expectation, according to the interbank market, is now sitting basically just on 50% by December of a chance.
All right, so let's change tack slightly. We've had Donald Trump come out in the last week talking about tariffs on steel and aluminium into the US.
Yes.
That's really spooked markets. And then today we've had Gary Cohen resigning. So let's just briefly talk about that. That's hit markets too.
It's economics 101, isn't it? It's fantastic. Like, you just sit there and go, the GFC, if we were ever going to look at protectionism globally, the GFC would have been it, right? It would have been a chance for all of these other nations that were in lots of trouble to basically protect their own patch, and globalization expanded. We now have the largest economy in the world growing at a reasonable clip, looking at protectionism policies with a populist president. It doesn't make any sense. Now, not only that, the other way to look at it is that the reason that even his own side of politics is so angry with him is that manufacturing is what they were trying to improve, not putting tariffs on aluminium and steel, manufacturing. And the Rust Belt, places like Pennsylvania, Ohio, Milwaukee, Minnesota, these kind of states up in that sort of northwest area, mid-northwest area, are the ones that really feel this, because that's where GM, Ford, Boeing, all these big manufacturing providers are based. If they're going to have to face higher steel prices because they have a tax increase from Canadian steel or Australian steel or Chinese steel, then they're going to feel it at their bottom line. It makes no sense. Anyway, Gary Cohen resigning is an even bigger issue, because he was probably the last main free market economist, economic advisor that he had. He's now got two protectionist guys sitting behind him pushing policy. And if Cohen obviously lost the debate, couldn't argue and reason with him that protectionism doesn't work, and it will actually in the end hurt the US. We've already seen Europe react last night with the increase on tariffs of pretty much all of US materials into Europe. This is going to end quite badly, and markets have already told you that. The futures markets in the States have plummeted on the news that Cohen's resigned.
We'll see what happens over the next few days, Evan.
Thanks, Tony.
Thanks for joining the Economic View.